but shift focus to real estate.
Yeah, let's do that. And Aisha, this was a stock that was buzzing away in trade yesterday. Prestige Estates really stole the show. A smart gain on the Nifty mid-cap. It's crossed its 200 DMA, and there's been a lot of interest in the real estate space as a whole as well. The improving trend in the residential segment, and a lot of these realty stocks, are they back in vogue? Let's find out from Irfan Razack. He's the Chairman Managing Director of Prestige Estates, joining in. Mr. Razack, good morning. Thank you for joining in. Give us a sense as to how things are shaping up on ground. A lot of brokerages now are turning fairly bullish. How is the commercial real estate panning out, and what are some of the strong trends?
On ground, things are quite good, especially like you said, commercial real estate is doing well. There's a good demand for spaces, and the rents itself have become stronger, and they are slowly moving northwards. And the best news is whatever we have produced or producing so far, we've got zero vacancy levels. So that gives us a lot of confidence. But as you know, we always have to be in this business, we have to be careful, we have to watch the trends, and we have to see that there's no situation again of too much of oversupply and then bring pain on ourselves. So we have to balance ourselves properly, nothing to get too excited about. But the best part is things are going on ground extremely good, and the demand continues, and that is a good sign. It's a great sign actually.
Why do channel checks are suggesting that there is a glut in real estate? I'm not specifically talking about the properties you own. There are always exceptions. But the general reality, or not the general, but the crude reality of the real estate sector is that demand is low, prices are not moving higher, there is more supply and there is less demand.
On this, now coming to on the residential side, now in certain pockets you do have excess supply vis-a-vis the demand, but then that again, what the supply they are counting is the supply which is not ready. Now this supply will take time to produce, will take time to get ready. It's not as though there are millions of houses which are ready to occupy and there's no demand for it or there's no taker for it. What really happens is it's a span of 3 years to 5 years to complete any development, depending on the size of the project. And then of course there are many other external factors like accessibility, location, infrastructure, the actual pricing, the product itself, the brand. All that really adds to the whole overall chemistry of somebody wanting to buy a home. And they have, since the choice is available, of course the customer is discerning, and they will definitely buy what they feel is good for them and for their families and for a price. Of course, there are things like confusion, like the GST rate itself. And now, see, as far as completed units are concerned, the GST applicability is not there because the cost is already built in. Now, the recent reduction in GST from 1st April, the announcement has come, but the modalities still have to get done, and from 1st April the customer pays only 5%. But what it has done is, this decision is increase the cost on the other side. So ultimately again, market forces have to prevail on the pricing and other things. We have to see how the acceptability of pricing as we go along.
Would you be going the REITs way very soon? If yes, how soon?
Not really, because embassy is now, just now, I think their REIT will be over and done with on the 20th, and I think I wish them all success. But I believe that we still want to produce more and create a nice larger bandwidth and make a meaningful portfolio at some point of time. So we are in that process, though we do have a lot of rental yielding assets both in the commercial as well as the retail, as well as hospitality, where we've got now 4 trading hotels, hospitality assets. So let's see. I mean, it's too early to call and say that we would like to. Right now there's no pressure on us, and we would like to take a call at some point of time where we feel that there is a better appetite, or whether there is more value to be unlocked at some point of time or the other.
Mr. Razack, what about the current situation when it comes to the debt of the company, and what are the steps that you're taking to reduce Your financial leverage?
Yes. Now this has been talked about quite a bit, but then I believe that whatever we've done so far, we are in a very comfortable position, because most of our debt, 60% of it comes from the lease rental discounting, where A, the interest levels are also low, and B, we do not have to find liquidity to either service the interest or the installment payment. And the endeavor at the company level would be, at some time or the other, just to have, if there is debt in the balance sheet, is just to have debt only for the lease rental discounting. And as far as the residential business, since so far we've been very fortunate and we've got positive cash flows, as far as possible, try and not have debt in the balance sheet for the residential side of the business. Yes, will continue to have a certain amount of debt for where asset creation is happening. And now as we go along, we will also be doing a mix of sale as well as capitalize the commercial assets. So that will also reduce the pressure. All in all, I believe we are in a fairly comfortable position. We are aware of it, we are conscious of it, and we would like to see that we do not get into any sort of stress at any point of time, and the comfort level keeps continuing.
Just to wrap it up from our side, the GST norms. Some would argue that the GST norms may not really make life easy for a builder. I mean, the numbers are out in the open, and we believe that the builders will have to take a hit on their margins, and that could create further pressure on their profitability. Is our broader assessment right?
No, I think you can't generalize it and say it in that one sentence. Now we have to evaluate this properly. The first thing is, if GST has come down from 12 to 5%, I think it's a very big positive. The customer psychologically also knows that he just doesn't have to pay a huge sum of money like 12% plus stamp duty, which was again between 6 to 8% depending on state to state, almost a 20% transaction cost. Now that has got reduced 5% GST plus the stamp duty, which we do hope the state governments also at some point of time will reduce the value of stamp paper. Now that is on one side. Now what has changed for the developer is that the input credit benefit that the developer was getting, so the cost that was being considered for the developer as X without taking the GST into consideration, because GST was just where money used to be collected from the customer and the input credit benefit was taken by the developer and the balance paid to the government. That now cannot happen. Now 5% is a straight pass-through to the government. So yes, the cost will go up, has gone up from 1st April. But then the thing is, it's not as though we are in a stagnant market. Obviously, we'll have to do our correction and our costing well. We'll have to do our homework well and do our pricing right and see that we are able to offer a better product to the customer at a fair price, where again the company does not take a huge hit on margins, and at the same time there's acceptability for the pricing from the customer side. But as we go in the long term, I believe it's a good benefit, and we need to calculate our costing based that it's not going to be zero GST on the hands of the developer. There will be a cost of GST.
Mr. Razack, thank you for taking time out and joining in. You're sounding fairly optimistic on the prospects of the sector as a whole. As of now, no plan for REITs, but that's the status check coming in on Prestige Estates.